Thank you for listening to the Council of Institutional Investors Voice of Corporate Governance. I'm Jeff Mahoney, General Counsel of CII. The purpose of these monthly episodes is to update CII members and the general public on significant developments in U.S. corporate governance and capital markets regulation and CII's related advocacy activities. This update covers a period from November 5th to December 3rd, 2024. The following is my top 10 list of events over that period. Number 10. On November 7th, the Best Practice Principles Oversight Committee, an independent body that governs the best practice principles for shareholder voting research and analysis, convened an open forum to explore the status and efficacy of monitored self-regulation of proxy advisors. The committee oversees the following 5 signatories of the Best Practices Principles Group. 1. Engagement Ownership Services of Federated Hermes. 2. Glass Lewis. 3. Institutional Shareholder Services. 4. Minerva. And 5. Pensions and Investment Research Consultants. During a panel discussion moderated by Michael McCauley, Senior Officer for Florida's State Board of Administration, Oida Rodriguez, Leader of Investor Relations for Air Liquide, raised objection to proxy advisors requiring companies to pay for access to reports on their own meetings. Rodriguez also expressed frustration with proxy advisors' internal communication breakdowns, particularly those between environmental, social, and governance research teams and the teams responsible for shareholder meeting reports and recommendations. Patty Gazda, who leads the governance program at the Ohio Public Employees Retirement System, acknowledged the value of robust feedback mechanisms. Gazda noted that the level of transparency provided by Best Practice Principles Group signatories improves the quality of information policymakers receive about proxy advisors' activities. Peggy Ferran, Chief Governance Officer at Prudential Financial, emphasized the value of strong firewalls between proxy advisors' corporate consulting and proxy research arms. Brand observed that over the last 2 decades, companies have become less inclined to reflexively cast blame on proxy advisors when they express negative views. Kyle Seeley, who heads the stewardship for the New York State Common Retirement Fund, stressed the importance of investors engaging with proxy advisors to ensure that any integration of artificial intelligence into their operations improves research quality and protects against errors. Edouard Dubois, head of proxy voting at Amundi, noted that more regulation of proxy advisors would raise barriers for new entrants to the industry. Dubois shared his belief that the Best Practices Principles Group creates a virtuous cycle of improving processes and transparency based on feedback and peer practices. Maureen Beresford of the United Kingdom's Financial Reporting Council expressed support for a principles-based approach to proxy advisors and noted the Financial Reporting Council soon will release a relevant consultation regarding the UK Stewardship Code. Number 9. On November 13th, U.S. House Financial Services Committee Vice Chair French Hill of Arkansas sent a letter to federal financial regulators calling on each to immediately halt all rulemaking actions. The letter, which he sent to 8 federal departments or agencies, including the U.S. Department of Treasury, the U.S. Securities and Exchange Commission, said the election results were indicative of widespread discontent over the Biden administration's regulatory overreach throughout the past 4 years. Quote, "This relentless rulemaking agenda has stifled economic growth and innovation and restricted consumer access to financial products," unquote. Vice Chair Hill urged each of the named federal departments and agencies to abandon any action or plan to force through a politicized regulatory agenda, which voters have already rejected. Number 8, on November 17th, U.S. Senate Banking Committee Ranking Member Tim Scott of South Carolina sent a letter to President Biden. The letter was also copied to the heads of 9 federal departments or agencies, including the U.S. Secretary of Treasury, the U.S. Secretary of Commerce, and the chair of the U.S. Securities and Exchange Commission. The letter urges the departments and agencies to cease all rulemaking, including the finalization of any pending or proposed regulations or guidance, and to comply with federal record retention laws and preserve all agency documents, records, and communications. In addition, Ranking Member Scott urges President Biden to withdraw all pending nominations within the committee's purview and pledges that he will not vote for or advance any nominees put forth in front of the committee by the Biden administration. Number 7, on November 5th, U.S. District Judge Otis Wright II denied the U.S. Chamber of Commerce's motion for summary judgment on its claim that California's climate disclosure laws amount to compelled speech and, as such, are unconstitutional. The U.S. Chamber of Commerce and other trade groups filed suit against the California Air Resources Board earlier this year in the United States District Court for the Central District of California. Their suit alleged the two state laws, which require large businesses to disclose detailed information on their carbon emissions and climate-related risks, arguing that the laws violate the business's First Amendment rights against compelled speech. Judge Wright said he needs more information before he can decide whether the reporting regime California intends to put in place violates the First Amendment. The laws signed last year by California Governor Gavin Newsom are set to roll out in 2026, could affect about 75% of Fortune 1000 companies. Senate Bill 253 would require business entities operating in California with annual revenues exceeding $1 billion to report their greenhouse gas emissions each year. And Senate Bill 261 would require business entities with revenues of more than $500 million to publicly disclose their climate-related financial risks. With the U.S. Securities and Exchange Commission's climate disclosure rule subject to a stay, and a legal challenge before the U.S. Court of Appeals for the Eighth Circuit, the California laws could potentially become the national default disclosures if they survive the legal challenge. Number 6, on November 14th, a 3-judge panel of the U.S. Court of Appeals for the Fifth Circuit upheld the U.S. Securities and Exchange Commission's no-action process for shareholder proposals. The National Center for Public Policy Research challenged an SEC no-action letter giving Kroger permission to omit the group's shareholder proposal from the company's proxy ballot under Rule 14A8I7, based on its pertinence to the company's ordinary business. The proposal requested that Kroger issue a public report detailing the potential risk associated with omitting viewpoint and ideology from its equal employment opportunity policy. The National Center for Public Policy Research argued the SEC's Division of Corporation Finance engaged in unconstitutional viewpoint discrimination when it gave Kroger permission to exclude the proposal. National Center for Public Policy Research sought reconsideration of the decision, but without success. Kroger ultimately included the proposal in its proxy statement anyway, and it received 1.9% of the votes cast. In a 2-1 split decision with 2 Democratic-appointed judges versus 1 Republican-appointed judge, the court dismissed the case for mootness because Kroger ultimately included the proposal in its proxy materials. The court also determined that it lacked jurisdiction to review the SEC's no-action letter, finding that such letters are informal, non-binding guidance provided by SEC staff and do not constitute final orders under the Securities Exchange Act or final agency actions under the Administrative Procedure Act, and therefore are not subject to judicial review. Number 5, on November 27th, 11 states filed a complaint against BlackRock, Inc., State Street Corp., and the Vanguard Group, Inc. The complaint alleges that the 3 asset managers worked to constrict coal markets through anti-competitive practices and misleading investors in funds that do not take environmental, social, and governance factors into consideration. The attorney generals from the 11 states filed the complaint in U.S. District Court for the Eastern District of Texas, Tyler Division, with lead representation from the Busby law firm based in Austin, Texas. The states alleged that the asset managers took substantial holdings in U.S. coal companies, which they leveraged to press the companies to focus on green energy goals. The plaintiffs also claim that the asset managers used positions in organizations such as the Climate Action 100 and the Net Zero Asset Managers Initiative to signal their work to reduce coal output, which the plaintiffs allege led to cost increases for coal-powered electricity. The plaintiff states that, quote, for the past 4 years, America's coal producers have been responding not to the price signals of the free market, but to the commands of Larry Fink, BlackRock's chairman and CEO, and his fellow asset managers, unquote. Lawsuits led by Texas Attorney General Ken Paxton includes the attorneys general of Alabama, Arkansas, Indiana, Iowa, Kansas, Missouri, Montana, Nebraska, West Virginia, and Wyoming. The plaintiffs are seeking billions in damages. In the complaint, the attorneys general also call on the asset managers to divest their investments in coal company stock and for the firms to be restrained from any further deceptive or misleading acts or practices related to the positioning of funds. BlackRock responded in a statement that its holdings in energy companies are regularly reviewed by regulators and that, quote, "We make these investments on behalf of our clients and our focus is on delivering them financial returns. The suggestion that BlackRock has invested money in companies with the goal of harming those companies is baseless and defies common sense. This lawsuit undermines Texas' pro-business reputation and discourages investments in the companies consumers rely on," unquote. State Street responded in a statement that the firm, quote, "acts in the long-term financial interests of investors with a focus on enhancing shareholder value. As long-term capital providers, we have a mutual interest in the long-term success of our portfolio companies. This lawsuit is baseless, and we look forward to presenting the facts through the legal process," unquote. Number 4, on November 22nd, Jaime Lizarraga, Commissioner of the U.S. Securities and Exchange Commission, announced that he will resign from the commission on January 17, 2025. Number 3, on November 7th, the staff of the Council of Institutional Investors released research finding that governance issues took center stage during this year's proxy season, with 48 shareholder proposals winning majority support at 46 companies between January and August of this year. As part of maintaining its board accountability list, CII monitors the implementation of majority-supported shareholder proposals at U.S.-based Russell 3000 companies. Nearly 2/3 of the majority-supported proposals sought simple majority voting policies in companies' governing documents, whether for uncontested director elections or other voting items. Of the 30 proposals, the majority exceeded 90% shareholder support. 27 of those proposals were filed by John Chevedden, while one was filed by Kenneth Steiner and 2 did not have their proponents disclosed. The overall volume of majority-supported shareholder proposals through August this year represents an over 50% increase from the 31 proposals at 29 companies, 9 of which were implemented during the same period in 2023. Notably, the proportion of majority-supported proposals pertaining to environmental and social matters decreased substantially. 2 environmental and 1 social proposal won majority support from January to August, down from 3 environmental and 5 social proposals from the same period in 2023. 4 governance-focused proposals were endorsed by management and 1 overwhelmingly as expected. Those include 1, ConocoPhillips to reduce supermajority vote requirement, 2, FMC Corporation to adopt simple majority vote, 3, U-Haul to ratify and affirm board and management decisions and actions in fiscal year 2024, and 4, Warrior Met Coal to adopt proxy access right. Cases where management did not back the majority-supported proposal, CI sends a letter to inquire about the board's review and response to the outcome of the vote and communicate the CI's corporate governance policies recommend that boards should implement majority-supported shareholder proposals. Number 2, in a November 14th speech before the Practicing Law Institute's Annual Institute on Securities Regulation, U.S. Securities and Exchange Commission Chair Gary Gensler touted the SEC's accomplishments, including those related to governance, accounting, and auditing. Chair Gensler pointed to the SEC's implementation of regulations during his tenure, including the following 6 items. 1, the closing of loopholes in Rule 10b-5-1 that allowed corporate executives to pursue fortuitously timed trades in company stock while in possession of material non-public information. In 2012, the Council of Institutional Investors submitted a rulemaking petition to close those loopholes and enhance disclosures about those trading plans. Number 2, mandating that the stock exchanges require their listed companies to have policies providing for recovery of erroneously awarded incentive-based compensation received by their executives. The rule, which derives from a provision of the Dodd-Frank Wall Street Reform and Consumer Protection Act that CII drafted, applies to all required restatements made to correct errors in previously issued financial statements. The rule was explicitly expanded during the SEC's rulemaking process to include little r restatements that are less transparent to investors, an expansion for which CII strongly advocated for. And number 3, requiring all reporting companies except foreign private firms, registered investment companies, and emerging growth companies to provide a table in their proxy statements that shows specified executive compensation and financial performance measures for their last 5 completed fiscal years. The rule was derived from a provision of the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was based in part on congressional testimony from CII's executive director requesting more quantitative disclosure about how executive compensation is determined. Number 4, providing additional investor protection in initial public offerings for special purpose acquisition companies by requiring disclosure to include a SPAC sponsor's compensation and conflicts of interest, equity dilution caused during the SPAC de-SPAC process, and information about target companies SPACs require. CII has been a long-time public and active proponent of improving the corporate governance of SPACs. Number 5, requiring companies to disclose information about any cybersecurity incidents that they determine to be material and the processes they use to identify and manage material risks from cybersecurity threats. And number 6, requiring companies to certify if the Public Company Accounting Oversight Board is unable to audit the reports because the companies retain a foreign public accounting firm not subject to inspection by the board, and requiring that companies at which the PCAOB is unable to inspect public accounting firms for 3 consecutive years be banned from trading on national exchanges. The rule was derived from requirements of the Holding Foreign Companies Accountable Act, for which CII was a longtime and active public supporter. Chair Gensler indicated that all these 6 rulemakings and others were part of an effort to update the rules of the road. He added that the Commission's efforts during his tenure lowered costs and risks in the capital markets, promoting efficiency, resiliency, and integrity. And my number 1 most significant development in U.S. corporate governance capital markets regulation for the period from November 5th to December 3rd occurred on November 21st, when the U.S. Securities and Exchange Commission announced that SEC Chair Gary Gensler will leave his post on January 20th. Gensler began his tenure on April 17, 2021, in the immediate aftermath of the GameStop market events. Recent press reports indicate that President-elect Donald Trump may tap former SEC Commissioner Paul Atkins, who spoke at CII's spring conference, as the next SEC chair. Gensler was formerly chair of the U.S. Commodity Futures Trading Commission. He was senior advisor to Senator Paul Sarbanes of Maryland when the Sarbanes-Oxley Act was written, and he was Undersecretary of the U.S. Department of Treasury for Domestic Finance and Assistant Secretary of the Treasury from 1997 to 2001. Earlier in his career, Gensler worked at Goldman Sachs, where he became a partner in the Mergers and Acquisition Department, headed the firm's media group, led fixed income and currency trading in Asia, and was co-head of finance. That completes my monthly U.S. corporate governance and capital markets update. If you have any questions regarding any of the issues discussed, please feel free to email me at Jeff, that's Jeff, at CII.org. Thanks again for listening to the Voice of Corporate Governance, and happy holidays.
Thank you for listening to this episode of The Voice of Corporate Governance, brought to you by the Council of Institutional Investors. The Voice of Corporate Governance is a free, non-sponsored podcast that highlights critical developments in corporate governance and other important issues affecting institutional investors. The views expressed by those interviewed on the podcast do not necessarily reflect the views of CII or its members. For more information on CII and its policies on corporate governance, please visit our website at www.cii.org.